All right, well, today we are going to keep moving on. I want to remind you that there's a couple of homeworks due, the 1, 2, 1, 3. We've actually done basically all of that material with the income tax, the deductions and credits. And we're gonna do the income tax returns, the marriage penalty today. And hopefully we'll get into some of these tax intricacies and property tax stuff. All right. So anyways, these two homeworks, the 1, 2, 1, 3 and the 1, 4, 1, 5 are due today. They're both due Friday at 5. Okay, so 2 homeworks due. There. Okay, so today we're gonna talk about income tax returns. All right. We've all seen that document, the income tax return document, like a 1040. It's the file that you have to send in to the government each year, either you or your accountant or whatever. And essentially what it does is it's a document that balances out how much you owe to the government versus how much you've already paid. So up till now, we've been calculating how much we owe to the government. But most people who work jobs, work a standard type job, get paychecks. And in each of those paychecks, your employer will withhold a certain amount. That withholding goes to the federal government as your income taxes. So income tax return is essentially a difference of what we owe versus what we pay. Now, I found a paycheck from a long, long time ago when I was a grad student, all right? And you can see down here, how this says what your salary, both the current paycheck and year to date, and federal and Michigan withholding. The federal withholding of my paycheck was like 50.13. And that 50.13 was sent to the government. Okay. So on everybody's paycheck stub, you would see this. Right. So let's go back to an example that we've seen before many times. Remember, in the first income tax calculation, we figured out that if a single person has an income of $50,000, and we assume no deductions and no credits, we calculated that they owed the government and the number was $6,790, right? That came from just the tax calculations that we did earlier. Right, 6,790 was what that person would have owed the government. Now the employer has already taken out $3,800. For federal income taxes. What's going to happen with this return? So basically what happens is we do our tax calculations exactly like we've been doing the last couple of sections. And then we just take what we owe minus what our employer withheld. So the income tax return take what we owe minus what we withheld. Hold these. Or vice versa. You know, whichever number is bigger. You can go withholdings minus how much you owe. But in this case, 6790 minus 3800. We just type that into our calculator. And we get $2,990. Now that $2,990 is that how much the government owes me or how much extra I have to pay towards the government? Well, if I owe this much, withholding is basically how much I already pay, right? So if I owe this much and I've only paid this much so far, that means I need to put extra. So withholding is less than how much I owe, mean I have to pay extra. So I have to pay, or this person, fictional person, let's pay in $2,990. Right? And there'll be a little, when you do these income tax return questions on Moodle, there'll be a little drop down that says, I get back from the government or I pay into the government, and then the numerical value. Is that right? So that's kind of how that works. Now, on the flip side, what if the employer has taken out more than what this person owes? So let's instead imagine that the employer has withheld $7,400. What's going to happen with their tax return? With the exact same scenario of single person, 50,000, therefore they owe 6,790. Oh, I don't want to do that. Well, if my employer has withheld more than what I owe, then I might just flip this. I might just say, take my tax returns withholdings minus how much I owe, just because that's the bigger number, 7,400 minus 6,790. Again, that's just something you type in your calculator. So you get $610. But because you've already paid in extra, the income tax return will say that the government needs to pay you in this case $610. And you get a check from the government for that amount. Yeah. So on Moodle, in fact, let me just do that. Let me go and show you what Moodle has. So on Moodle, when you go to the income tax returns question, then it'll say this, the couple, and then you say owes to the government or gets back from the government. And so when you write your amount, it'll always be a positive amount. So that's kind of how it works. You pick owes to the government $610, or in this case, gets back from the government $610. Now that's not the answer for this problem, that's the answer for probably just get on the board. Okay. But yeah, always put a positive number in the amount of. So let's do one together. In this case, it says a married couple filing jointly has an income of $98,000. Now the employer has already taken out 6,200. That's the withholdings, right? So I'm just going to call that withholdings, 6,200 on the board. And it says this married couple is going to take the standard deduction of $24,800 and has $400 in tax credits. This kind of puts everything that we've done so far together, right? What should their income tax return say? Or what should their income tax return be? Oops, don't have that. So we go to our file and we want to calculate how much this couple is going to first owe in taxes. So we have to do what we did in the last section first, and then move on from that. Does that make sense? If you remember our last section, what I have to do is say, well, if the couple had $98,000 and this amount of deductions, what we're gonna do is say that their taxable income is 98,000 minus the deductions. So that's a taxable income of 73,200. Okay. So taxable income is 73,200. Now, the tax before credits, we get that from looking up on our tax rate schedule. We're gonna take that 73,200 look at the married filing jointly. 73,200 is in this category for married individuals filing jointly. So they're in the 12% tax bracket. Everybody get that? Be careful of that. The tax bracket is determined by the taxable income. Sometimes after deductions, you're in a different tax bracket than before deductions. Okay. So this person is in the 12%. And the 12% tax bracket says take 1,975 plus 12% of the excess income over 19,750. $19,750. All right there. So that's the tax. At least how I calculate the tax. Excess over 19,750. The difference between 73,200 and 19,750. Remember the difference between our taxable income and that 19,750 is how that works. So I get that 12% applied on $53,450. Then I type this into my calculator. I ended up with a tax of $8,389. That's before credits, right? Your tax after credits is going to be calculated by just subtracting this $400, right? So the tax after credits, right over here. I take my before credit tax. Track my credits. tax amount after credits, $7,989. Right? So that's how much I owe to the government. That's how much I should have paid to the government. Now, the tax return it's going to say, what's the difference between that number and the withholdings that I've already paid in towards the government, or that my employers withheld, paid in towards the government. So what's the difference between 79.89 and 6,200? It's 1,789. Do I need to pay in 1,789, or do I get back 1,789? For this married couple, do the married couple have to pay in that much, or do they get back that much? They pay in, right? Because their withholdings was less than how much they owe. So therefore, this couple must pay to the government $1,789. Is that right? So the tax calculation works exactly the way it did before. And then we have this additional step of figuring out what's the difference between what I owe versus the withholdings. Everybody get that? Fine. No. Oh, shoot, sorry, it's not projected. I want you to try this one on your own. Again, you might, I'll project that the sheet on the board for the single, triple, or unmarried individuals if you don't have it, but you'll have that to reference. All right. Let me go through this. Oops. So this is a single person, income is $68,000. My withholding, or their withholdings were $10,440. They're gonna take the standard deduction of $12,400 with no tax credits, okay? Now, their taxable income is going to be their income minus the deductions, which turns out to be $55,600. That puts them in the single person 22% category. Oh, that's a married individual, excuse me. I was projecting this. Yeah, so it puts them into this category. So they're in the, what's called the 22% tax bracket, which again, doesn't mean that 22% of their income goes to taxes. It just means that their part of their excess gets taxed at 22%, excess over 40, 125. So the tax is going to be 4,617.50. Plus 22% of the excess over $40,125. Again, this part is all the same as what we had previously. I take the taxable income minus the 40,125. Actually, I didn't calculate this yet. Should have, but I get 15,475. That's the amount that's taxed at 22%. When I put that in my calculator, I get that the tax should be $8,022 before credits are applied. Now, this person has no credits, they said. So the tax after credits is just 8,022 because we're not changing it by any credits. In fact, I would imagine there's a lot of taxpayers out there that don't get any tax credits out there. So what I'm gonna do is I'm gonna take the withholdings difference between the withholdings and the tax after credits. And if you take that, you get $2,418. Now, does that mean that they are going to pay in an extra $2,418 to the government, or do they get it back from the government? They get it back this time, all right? This person gets back from the government $2,418. Now, here's one of the weird things people talk about. They talk about people who don't pay any taxes. This person still paid taxes, right? If you look at what happened, this person actually, over the course of the year, paid $8,022 in taxes. Okay. So over the course of the whole year, they did pay taxes, but their income tax return gave them back money. And oftentimes this is what happens. That, you know, you pay in over the whole year through paycheck withholdings, and then at the end you get back some money because of how the withholdings work. I won't get into that in too much detail, but because of how the withholdings work, oftentimes people get back money on their tax return. Okay. But just because you got money back on your tax return doesn't mean you didn't pay taxes. Again, this person paid $8,022 in taxes over the course of the year. It's okay? Fairly straightforward. Easy, not too bad. People were doing all right with it while I was walking around, so. I think what I'll do is I'll skip the last example. That's a very similar example, so I'll skip that and go straight to the next section. So I skipped example 5 if you're following along in the notes. And I'm going to go straight to the next section, which is about what people call the marriage penalty. Now, this has nothing to do with somebody disliking their spouse, all right? This is about taxes once again. So here's the basics of it. Remember that when we looked at the income tax brackets, that very, very top bracket had some weird numbers. Like the married jointly, almost all the numbers were exactly doubled. The categories were almost exactly doubled, except for the last one. Well, if you find yourself in that last category, weird things could happen. I'm going to do this with an example. And we're going to make it fairly straightforward. Let's assume we have a married couple who files jointly. And their income is $2 million. And we're going to assume no deductions or credits. So we're going to make this as simple as we can. Okay. Let's figure out how much they would pay in taxes. So we got to go to the married individuals filing jointly. Obviously, 2 million puts us in that last category. That's why I took the number so high. This is definitely not my wife and me, right? Be nice if it was. She needs to make about 2 million. That'd be fantastic. But anyways, last category says that the tax is going to be $167,307.50 plus 37% of the excess over $622,050. That last category on married filing jointly. All right, so again, we assume no deductions and no tax credits. So assuming no deductions, all we have to do is put in, oh, sorry, 37%. All we have to do is put in this 2 million. And then do the calculations. So the tax is going to be 167,307.50 plus 0.37 multiplied times 1,377,950. Gonna take a minute to type that in, but. So the amount that they would owe in taxes would be, here's what I got. I got that their taxes would be $677,950. $149. All right. Let's say next year they get divorced. These two people get divorced. And that next year, each one makes $1 million individually. Okay, so how much does each pay in taxes? And if you double that tax amount, how much would they pay together? Everybody get that? So they're going to be in the single category, making $1 million. $1 million each. So the single category, making $1 million, gets you a tax of 156,235 plus 37% of the excess over 518,400. Is that right? I gotta write that down because I'll forget it if I don't. So I'm writing that down on the board. All right. Now I break it down. So this is gonna be, there's two people here though, remember? We have single, so we have two single people that each make an income of $1 million. So for each individual, we're gonna take that 1 million, subtract 518,400. That gives me 481,600. I typed that in my calculator, and what I ended up with was that the tax on each person is $334,427. That's for each person, right? because there are now 2 individuals, let's just multiply that by 2. If I multiply the tax by the 2 individuals, you get $668,854. That's how much the 2 people together would pay in taxes. Everybody follow along with that understanding? So each one individually pays $334,427. And if you double that, because there's 2 people there, they pay $668,854. So do these 2 people pay more in taxes if they are married or, well, married or as if they were divorced? Yeah, they pay more in taxes if they're married, right? And that's a direct result of that weird capping of the numbers at different values in that highest category. Okay, so that highest category being different means that some couples are going to pay more taxes if they're married than if they would both together stay single. Now, it's not always that way. There are some people who are actually going to benefit from being married in the tax calculation. If one person makes 2 million and the other person makes 0, right, then that's a different calculation. Here, I said, let's assume both people make 1 million. So it's slightly different calculations. I think it actually gets worse if you get, let me think. I can't remember exactly what happens, but I believe it gets worse if you actually make it more disparate, right? If one person makes 2 million, one other person makes 0. And both single. I can't remember exactly though. But this phenomenon is the marriage penalty for taxes. All right. So the marriage penalty is when a married couple is going to pay more in taxes as a result of being married than they would have if each were unmarried. And by the way, married filing jointly versus married filing individually, the married filing as individuals is actually usually worse. So in those high tax brackets. Now, in the 2020 tax brackets, the only time this actually happens is at that very top tax bracket. Okay. It's in that 37% category. Otherwise, it really doesn't matter. As long as you split it evenly, I should say that. As long as you split it evenly, it's not going to matter a whole lot. So again, the marriage penalty only happens in that top tax bracket if you do the even splits. It used to happen at lower income levels. Previous to 2016, 2017, the tax brackets didn't double quite as nicely at those lower income levels. And so they were all kind of weird. So the 2020 tax brackets are kind of nice in a lot of ways. All right. Now, I'm referring to this as the marriage penalty. There are some other things that people may refer to as a marriage penalty in other financial realms as well. And it just happens to do with you don't get as much money if you're married as if you're single. Okay. So certain benefits can accrue to a single mother or a single father at lower income levels that wouldn't actually count if that person had a spouse who made the same income. All right. So when I say marriage penalty in this class, it'll always refer to this income tax issue, but in other realms, it can apply to other things as well. All right, like if my wife and I, so my son is getting close to college age, right? If my wife and I got divorced, he'd be able probably to get more financial aid than he's going to be able to get. Does that make sense? Just because of the way income's calculated. All right. So things like that. But marriage penalty in this class will only refer to the taxes issue. Does that work? And that's it. That's the whole thing. That's what the marriage penalty is. Just a weird thing. If you ever hear that, or if politicians talk about that, that's what they're talking about. People used to talk about it a lot more before these new tax brackets came out, because before these new tax brackets came out, the marriage penalty and taxes could happen a lot of the lower incomes. Now it only happens if you're, above $500,000 or above $1 million together. Now I'm going to go through some of these bonus sections, right? The sections that aren't going to be asked about on the test, but you have these extra homeworks for. So I'm going to go through these sections. I'll do it fairly quick. Because they are a bonus, but we'll go through the idea. Now, I've been referring to income so far. Every time I write income is equal to $80,000, or income was equal to $98,000 or something like that. That actually was the income before taxes. When you get a job and they say, we're going to pay you $60,000, what they're telling you is the gross income. That's the income before taxes are taken out. So if they say, we're going to pay $60,000, that does not mean at the end of the year, you're going to be getting $60,000 more in the bank. Does that make sense? What you're going to get in your bank is your net income. That's the income after all the taxes are paid out. Right? So that's one of the intricacies. When we talk about income, people talk about gross income versus net income. Gross income is the income before taxes are taken out. Net income is the income after you take out taxes. So we saw, again, our standard example, the single person who has a $50,000 income. We've calculated that this person should pay $6,700 $790 in taxes. That means their gross income is going to be the $50,000. And the net income is going to be the $50,000 minus 6,790. All right, I'm gonna just do that on my calculator, 50,000, I forgot what it was. So their net income is actually 43,210. And that's just the net after federal taxes are withheld. If you also withhold state taxes, and you might withhold Social Security, and you might withhold some other stuff, then it might be even less than that, right? Is that all right? Gross versus net. So gross income versus net income, since we were talking about taxes and especially income taxes, I want to talk about that. And so far, when we've talked about what percentage of your income goes to taxes, so far, we've always used the gross income, $50,000, right? What if we also found the percentage of taxes compared to the net income? Write that down. So we're going to find the percent of taxes out of the gross income, and then the percent of taxes out of our net income. So our percentage of taxes out of gross income, again, I just take my taxes out of my gross income. So I take 6,790 divided by 50,000. We've done that calculation before. When people talk about percentage of taxes, they almost always talk about it this way. And we get 0.1358. So as a percentage, that's 13.58%. Is that okay? By the way, on your notes, leave a little blank after this if you're writing this linearly, because I'll go back and write a little word there in just a second. And this is a specific thing. So just leave a little bit of blank. I'll come back. The percentage of income or excuse me, the percentage of taxes out of your net income. We take the 6790 divided by, what was that, 43,210? And you get about 0.1571. The reason I'm going out 4 decimal places is that when I change it into a percentage, that's 15.71%. Again, leave a little blank after that. It'll be a specific word. So notice that if you take your percentage of taxes out of your gross income versus the percentage of taxes out of your net income, you're paying about 13.5% of your gross income towards taxes and about 15.71% out of your net income towards taxes. Okay. This is the one we usually report on income taxes. Okay, this is the one that people keep track of. Now, the reason I said leave a little blank is because these two different rates have special phrases. The one where the taxes are included, the one that's used with gross income, is called an inclusive tax rate. The one with taxes taken out, in other words, the one using the net income, is the exclusive tax rate. So the inclusive tax rate is the one with the gross income. So back on your notes, next to the percent of taxes with the gross, you can just write inclusive tax rate. So inclusive tax rate is the gross, and the exclusive tax rate is the one with using the net income. Okay, that's what I was gonna put in that blank I just said. Almost always when people talk about income tax, they use the inclusive rate. They use the one that's going to give you the smaller percentage. Right? It's a little bit more natural to do. I think I'll skip this example too, because we don't need that many examples here for the extra material. But what I will do is I'll contrast this with the sales tax. Let's say I went to some state and I buy $100 worth of goods. and pay $108 at the checkout. And that's a pretty easy calculation. How much sales tax was added there? Not a trick. How much sales tax was added? As you got this. And that's not a trick, but it's just. The sticker price is 100, you pay 108. Don't make it harder than it needs to be. I think you're doing it. Yeah, you paid $8 in sales tax, right? Everybody follow that? Yeah, you just paid $8. Okay. You just paid $8 in sales tax, right? So we paid $8 in sales tax. Now, here's the interesting thing. When you say what percent of, this is like the sticker price. Mute this. What percent of the sticker price did you pay as taxes? You put the tax amount over the price of the goods. Again, price of the goods, the sticker price is 100. So 8 out of 100 would be 0.08, which is 8%. Now I'm gonna write a word there in a second, so just hold with me. All right, leave that little bit blank. And then if you ask what percent of the checkout price was paid in taxes, you take the tax over the checkout price. So you take 8 over 108. I don't know what that is yet. It's a slightly smaller percentage, 0.0741 if I round to 4 decimal places. And I'm rounding to 4 decimal places because if I write that as a percentage, that's 7.41%. And again, I'll leave a little blank there so I can write a word. Remember, inclusive tax rate is the one with the taxes included. For a sales tax, taxes included is the checkout price. That makes sense? So technically, the inclusive rate is the 7.41. The exclusive rate is the ones where taxes are not included. that would be the sticker price. Taxes haven't been included yet. That's the exclusive rate. Now, I want you to notice, well, maybe not notice, I want to say this. When people compare income tax rates to sales tax rates, one of the things they often forget is that when you get a sales tax rate, it's actually an exclusive rate. This is the one that gets published, the exclusive rate with sales taxes. So when we said earlier that Michigan has a 6% sales tax, that's a 6% exclusive rate. If I told you Michigan has a 10% income tax rate, that's actually an inclusive tax rate that gets published. So when you're comparing sales taxes percentage rates to income tax percentage rates, you're not actually comparing apples to apples. All right? You're comparing an exclusive to an inclusive rate. Oftentimes when people will say something like, well, we should replace the income tax with the sales tax. And you say, well, what sales tax would that require? Well, the sales tax that required, if it were an exclusive rate, would seem a lot higher than the inclusive rate that your income tax would be. Does that make sense? So if you were to replace 13.58% income tax, you'd have to probably put a sales tax of about 15%, or 15 to 16%, all right, to make them mesh up. Okay, follow that? So that's one of the sort of intricacies of taxes, is that we have these inclusive rates and exclusive rates, and with sales tax, we almost always tell everybody the exclusive rates because you start with the sticker price and then you go up from that, right? That's kind of how the taxes work on sales tax. Whereas on the income tax, you start with your income and you lower it. And so you get an exclusive tax rate with your income tax. Weirdly enough. All right. So that's a weird tax intricacy that I wanted to mention. Okay. And I skipped the example. There's like people who want to abolish income tax and just go to a sales tax. And there's a calculation example of what that would take, right? What rates that would be. We don't need to go with that though. All right. I'll take a couple of minutes to kind of talk about property taxes. I'm not going to go into a lot of detail about this. And again, property taxes and this exclusive versus inclusive stuff, that's not going to be on the test, right? This is like bonus homework. But I wanted to at least mention it here. So, anytime you own a property, you often have to pay taxes on that property. Now, depending on the state and the system and all that kind of good stuff, sometimes you get taxed just on real property, which means like the land and the buildings. And then other times, machines and equipments and signs and all that kind of stuff can be taxed too. That's personal property. Right. So there's all kinds of different things you can be taxed on. Again, I won't get into that. For the purposes of this, to make it easy, think if you own a house or if you own an apartment building or a business or something like that. All right. Now, property tax is very variable. All right. The property tax that I pay is not the same as the property tax that people 2 miles away from me pay. Okay. The tax rate. It really depends on what state you're in, but also the municipalities. So people in the city of Mount Pleasant actually pay slightly different rates than people slightly outside of the city of Mount Pleasant. Okay. And it all depends on this thing called a millage rate. All right, millage rate. What the city or the municipality does is they assess your property and they give you a taxable value on your property. So let's say the taxable value on your property is $100,000. That doesn't mean it's going to sell for $100,000. It might sell for $200,000, but the taxable value might still be $100,000. Kind of weird, right? So you get a taxable value. And what the millage rate does it's the tax rate per $1,000 worth of taxable value. So if you have a $100,000 taxable value house, that means you multiply everything by 100. Do you get that? All right. So it comes into a really fairly easy formula. You take your taxable value, you divide it by $1,000. You take whatever value, divide it by $1,000, and then multiply it times your total millage rate. And that's the taxes you have to pay. All right. Again, millage rate is kind of weird because of this per $1,000 taxable value deal. So you just take the taxable value, divide it by 100, divide it by 1,000, and then multiply times the millage rate. And that's your property taxes. Pretty straightforward, right? All right. I won't do any calculations here because we're out of time. But again, you can see where those calculations come from. All right. Good follow? So once again, before next time, make sure you finish up the 2 homeworks that are due Friday at 5, the income tax stuff. And then if you want, you can do all of the bonus homework right now too, even though that's due next week, Friday at 5. So make sure you get those 2 homeworks due, or make sure you get the 2 homeworks done by Friday at 5. You all right with that? All right, I'll see everybody next week.